Buying a home can be extremely stressful. Knowing the mistakes to avoid when buying a home can alleviate a lot of that stress. If you want to learn more about real estate and mortgages, make sure to subscribe to this channel. And if you're going through the home buying process and have questions about your own scenario, make sure to leave a comment below. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career, putting me in the top 1% of loan originators nationwide. It's with this experience, I'm going to share the critical mistakes that home buyers make when planning to purchase a home. In this video, I'll discuss each of these mistakes in detail to help you avoid making them when it comes time to buy. Number one is not getting pre-approved for a mortgage. So mortgage pre-approval means that you're connecting with a bank, a lender, or a mortgage broker to make sure you qualify to purchase a home. They're going to go and they're going to discuss your purchasing goals, your home buying goals, what your comfortable payment will be. They're going to pull your credit. They're going to review your income documents, your asset documents, verify your employment in order to determine exactly what you qualify for when the time comes for you to buy. But the pre-approval that sometimes gets misconstrued means before you go out looking to buy a home. It doesn't mean before you close on a home. So you want to go get pre-approved. It's extremely, extremely important. And I'm not talking about a pre-qualification. Some banks will do a pre-qualification, which means they have a conversation with you by phone. They may pull credit and they don't collect a single document from you to verify the information you've provided by phone. However, that really does not hold any weight in the home buying process. What you want is a pre-approval where they do collect the documents, they do review the documents in order to make sure you're qualified. Now, there are times when someone's like, I don't want to provide all of these items. I don't want to give pay stubs and this and that or tax returns, right? Keep in mind, any lender who's willing to review those things up front is doing it for free, right? When we do that, we're doing it to look out for your best interest. We want to make sure that if we tell you you're going to qualify to buy a home, that you're able to buy that home. I'm not going to say banks don't care, but in all honesty, it seems like they don't, because they'll issue pre-approval letters like they're nothing. And then when the time comes and you go under contract on a property and now you have money at risk in the form of your earnest money deposit, if they have to deny your loan, they'll just deny your loan. You're just another loan number to them. You're not a person. I know that anyone who works like myself and my team, we know you as an individual. So when we go ahead and we issue a pre-approval letter, we stand behind that pre-approval letter. But we only issue that if we've reviewed everything up front and we're confident that you truly qualify. So it's not about punishing you and making you send extra things and doing a little bit extra legwork on your end. We're doing the extra legwork up front to ensure that you're going to be able to close on a home once you find it. So do not make the mistake of not getting pre-approved for a mortgage up front. Now, you also want to overlook additional costs that come along with buying a home. Do not overlook them. The next mistake is overlooking additional costs. When you buy a home, you don't just need a down payment for that home. Now, there are loan programs, and I've talked about this before, where you don't even need a down payment, right? There's down payment assistance. It will cover your down payment. Check out my videos where I explain what those programs are. But assuming you're not using a down payment assistance program and you know you need a down payment, also keep in mind that you need other money for the purchase. I'm talking about money for your settlement costs. These are the costs that are going to come from the lender, the title company, the government, right? The state in which you're purchasing. It's items you have to pay up front, like prepaid items like homeowners insurance and property taxes. It's money you have to put into an escrow account. Once again, homeowners insurance and property taxes, right? These are all things you need to consider. When you go under contract for a property, even if let's say you're getting a seller credit to cover your closing costs and you're doing 100% financing because you qualify for some sort of down payment assistance program, you're going to have to give an earnest money deposit. I don't know any seller in their right mind who's going to accept a contract on their property, take their home off the market, and you haven't given any sort of deposit that's held by the title company up front. That's called your earnest money deposit, right? Now, some markets will allow that to be as low as 1%. There's no real set amount, but let's just say it's a $500,000 property. We're talking 1% is $5,000. You need to be able to put that in escrow, right? It shows that you have some skin in the game. Doesn't mean you're going to lose that money. It will go toward whatever is needed for closing at the time you close. However, if you don't meet your contingencies of your contract, and you can learn what those are by watching my video where I explain a contract and what contingencies are, but If you meet all your contingencies, that money just goes toward your closing. If you miss those contingencies, the seller can take that deposit. So you have to have some skin in the game, because the seller can't be the only one taking risk in the transaction. They're certainly not going to. I've never seen it, and I don't expect to see it going forward. You're also going to want to have money available for a home inspection. Home inspection is not required, but I certainly recommend having one done. So you're going to want to set aside another, $500 to $1,000 for your home inspection. You're also going to need an appraisal on the property if you're getting a mortgage, assuming that you're not putting 20% or more down and you don't have what's known as an appraisal waiver, where there are some homes that don't require an appraisal because there's enough data available in the appraisal database where an appraisal is not required. Well, assuming you need an appraisal, which is, let's call it 90% of all mortgages need an appraisal, well, you're going to need money to pay for that appraisal. So that's another $500 to $750 for that. So make sure to set that money aside and plan for those costs on top of your down payments. Now, this next mistake kind of goes hand in hand with getting pre-approved up front. Not checking your credit score early. And by early, I mean well in advance of when you plan to buy. Because if there's anything on your credit report that needs to be addressed, maybe a collection you weren't aware of, or high credit card balances that need to be paid down, or maybe you need to get added as an authorized user to someone's credit card in order to improve your credit scores, right? These are things that take time. So if you wait to have your credit checked right before you're ready to buy, and I mean right before, let's call it, you're planning to buy in the next 30 days, you're not really giving yourself enough time to address these things. I recommend that you look at this at least 90 days out from when you're planning to buy so that you're prepared when the time comes. Now, you can track your own credit scores. You don't necessarily have to have a lender do it for you, but if you want the most accurate credit scores, you're going to want to use the MyFICO app or go to myfico.com. And by the way, I'm not paid for this, but I can tell you that MyFICO is going to have the most accurate credit scores that you're going to see when comparing to a lender. Because maybe you already had your credit pulled by a lender and you said, wait a minute, what you're pulling is way lower than what I see on Credit Karma or what I see on my credit card website, right? And that's because the scoring model used for a mortgage is different than what you're going to see through those consumer credit reporting sites. What's nice about MyFICO is that you can actually choose the type of credit you're applying for, and it will tell you the exact scores with all three credit bureaus for what the scores will be when you have it pulled by that lender, for example, if it's a mortgage company or if it's an auto loan. In this case, mortgage is what we're talking about, but the scores on there for mortgage will match exactly what the lender will pull when they pull it for you. Now, maybe you don't want to pay the money for MyFICO because you have to pay like $39 a month for that app. Although you can cancel at any time, you still have to pay for it. You can actually have a lender do a soft credit check if you're not ready to have a hard inquiry. A soft credit check means that you get all the same information that's on the credit report that would be used for underwriting of a mortgage. It just can't be used for underwriting of a mortgage. And it won't impact your score when it's pulled. It will show the credit scores and everything that's listed on the report. And then the lender can give you some feedback on that. Benefit to having your credit pulled by the lender, if there are things that need to be addressed, like I mentioned before, paying down credit card balances, collections, whatever it might be. Most lenders have the ability to run a credit simulator for you, and they can tell you exactly what you should do in order to boost the scores, rather than you kind of navigating it on your own if you're trying to look on the MyFICO app, for example. Next mistake is making big purchases before closing. Now, this may go without saying, but you do not want to apply for or make any large purchases before closing on a home. Especially in situations where your debt to income ratio is already high, meaning you're already near the limits of what would allow you to qualify or be disqualified for a mortgage. Right? You go out, buy a new car, lease a new car, any type of loan. I know you want to buy new furniture for that house. And I get calls and text messages from clients of mine that, oh, I'm at the furniture store. Is it okay if I apply for the credit card? No, do not apply for a store credit card or go buying new furniture unless you're paying cash. Why would you put yourself at risk of losing your home to save 10% because of the Memorial Day weekend deal on a couch? You need to save $500 that bad? You're trying to buy a $500,000 property. Just wait, right? Wait. So don't make any big purchases or apply for any new credit while in the mortgage process. Ignoring market trends. What's happening in the market? What are you seeing as far as property values are concerned? What types of properties are moving? How they're moving? Right? All this is extremely important to consider. Are home prices coming down in some areas? Are they going up in other areas? Are homes selling under asking price in the area where you're looking to buy, right? If on average, homes in the area where you want to buy are selling for under 3% of what the list price was, well, if you know that information, you can go in and offer based around that, right? Oh, I know homes are selling for 3% under in this market. I'm not asking you to reduce the price, seller. What I want you to do is actually give me a 3% seller credit to help me with a temporary rate buy down. It's going to reduce my interest rate for the first couple years. If you're not sure what that is, you want to learn about it, check out my video where I talk about temporary rate buydowns. Next is going to be neglecting to hire a home inspector. Now, this happens after you go under contract. A home inspector is going to come in and they're not going to say, oh, some will. Oh, there's a scratch on that cabinet. You can see the scratch on the cabinet. I can see the scratch on the cabinet. That's not what we're talking about. We're talking about underlying issues. Are there electrical issues, plumbing issues, issues with the roof, the air conditioning unit, high dollar items that you might need to take care of after you close on the home? In your contract, you're going to have an inspection period. That's your contingency, the inspection. Now, in a normal market, it's 7 to 10 days, right? That means you have to have an inspector go out, inspect the home, show you what these deficiencies are. Your realtor, if you're not using a realtor, I highly recommend using one, but if you're not, you or your realtor need to present those deficiencies to the seller and their agent to make sure they're addressed. You can have them fixed, you can ask for credits to fix them, however you want to handle it. But you need to hire a home inspector. Don't figure you're going to go do it yourself, unless you're a home inspector, of course, or a builder. You want a professional to come in, and yes, it is a cost, right? I mentioned knowing about the extra cost up front. Home inspector would be one of those, right? So it's $500 to $1,000. It's well worth it. Spending $1,000 for a home inspector up front could save you tens of thousands of dollars in the future if you close on the home and then find out you need to replace 2 air conditioning units, right? Spend the money up front, get a home inspector. You don't want to be cheap when it comes time to buy a home. And if you don't have the money for a home inspector, realistically, you probably aren't ready to buy a home. And also, once you're under contract, you never want to skip the final walkthrough. Make sure your realtor schedules that for you. Because remember, when you went and you saw this home initially, it likely had furniture in that home, right? The final walkthrough, you're going to go with your realtor. You're going to make sure that the seller took all of their belongings out of the home, assuming it wasn't part of the contract for you to receive them, right? Most contracts don't call for you to receive the furniture and personal belongings. You want to make sure the home's emptied out, and you want to make sure there was nothing, a rug comes up and the floor is destroyed. There was a rug there when you did your initial walkthrough of the home before you submitted an offer. Rug's gone, floor's destroyed, right? Holes in walls because they took all the paintings off the walls. It could be a multitude of things. You want to do a final walkthrough. You want to look for any of these items that could be an issue to you. There are plenty of times when, in the final walkthrough, by the way, usually happens a day before closing or the day of closing. There are plenty of times, though, where I get a call from the realtor or the client saying, hey, Brandon, I just want to let you know you're going to get an addendum to the contract for another $3,000 seller credit because we just did the final walkthrough and this place is a mess, right? And now the seller said, you know what? I apologize. I'm going to give you an extra $3,000 toward your closing for the hassle. Right? So you want to do your final walkthrough. It's extremely important to do that because you don't want to risk there being issues with the home that you couldn't see prior to the home being emptied out by the seller. Hopefully watching this video will prevent you from making these common mistakes. If you found the information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have any questions about your own scenario. I reply to 100% of the comments left on my videos.